Our next point in the program is what we call the Corporate Finance panel. So a panel discussion in which we will talk about, well, financing the life science ecosystem in challenging times. We'll talk about a little about valuation, talk about investor sentiment, and market trends. And with me to discuss these highly interesting topics, I have an expert panel consisting of Benjamin Nordin from ABG Sundal Collier. Välkommen. Vi har Dan Bergström från Erik Penser Bank, Anna Boqvist från Carnegie, and sorry, this is an English-speaking panel. I just remembered. Jakob Lindberg from Sedermera Corporate Finance. Very welcome, all of you.
Thank you.
Thank you.
So, like I said, a challenging market right now. First, there was a pandemic that hit the world, and then now there's inflation rates going up, there's interest rates hiking, and of course, then we have the Ukraine situation. My first question to you is, do you see any key similarities or differences between what we saw when the pandemic hit and the current situation in terms of financing challenges? If I start with you, Benjamin.
Okay, yeah, I think it's a huge difference. I mean, from our regard when it comes to capital market transactions and M&As and all of that, there was a lot more activity during the COVID, and the reason is basically that, I mean, compared to now, where we have interest rates, and compared to then when we didn't have interest rates at all, almost money was almost for free. There was a lot of activity then. Nowadays, it's much harder to get transaction through the door. Deals are being made, but it's much more selective, I would say. That's the main difference. So it's basically, it has to do with the macro environment and interest rate hikes, I would say.
Yeah. And Don, do you have the same experience from Erik Penser's?
Yeah, we pretty much agree with that picture. I think we can see similarities with the beginning of the COVID pandemic, where there was a lot of uncertainty and there was a huge valuation gap between the companies and the investors' point of view. But where during the COVID, the central banks and the government, they could stimulate the economies by massive purchases of bonds and lower the interest rates or keep them low, while they now do the contradictory movement of that. So that's a big difference. They're actually putting a price on the future cash flow, which means the valuation of the companies go down for that reason.
And Anna, from Carnegie's perspective, you take place in quite large transactions often. What's your take on the whole situation?
I agree completely with what has been said, and we share the exact same picture. And listening to a lot of those great companies presenting today, we hear that many of you share the same view. It's a very challenging market out there. And however, as just described, we believe that deals can be done, but there's a very big shift in what investors focus on and what is really key in getting the deals out there and get them over the wall and get them completed. And much more focus, and I'm sure we will come back on that, but much more focus from equity investors on liquidity, on near-term news flow, on cash flow, and conservative use of approach of proceeds when you raise cash. As opposed to 1 or 2 years ago. I think looking at in a more historical perspective, I think the last 1.5, 2 years during the pandemic was what we see a bit of one-off with this low interest rate environment and the really risk-on appetite from different sort of investors. Now we see much more of the opposite and maybe more normalized markets going forward and into 2023 and 2024.
Jakob, from Sedermera's perspective, do you agree with the former speakers? Do you have any other thing to add there?
Well, they have said many intelligent things here, I would say, so I agree with everything. But I would also like to add that we should not forget that the markets for healthcare companies started to turn already by late summer 2021. If you look at the healthcare index, it topped out somewhere around then, and then it dropped around 50% even before the war and before interest rates and before everything. So there has been this rotation for quite some time, and we are now seeing, the more difficult, even more difficult situations coming up as a part of this, or as a result of this.
And if we stay with you, Jakob, for a second, obviously the IPO activity has completely come to a grinding halt, you could say, for obvious reasons. And number of capital raises is perhaps also down a bit compared with the previous years, obviously. Do you see then in your network, do you see many companies that are in fact in great need of capital, but they still choose to sort of wait and see and try to wait for better times?
Well, I think that's definitely true for the spring, the first half of 2022. A lot of companies chose to postpone mostly IPOs, but also some rights issues were postponed until after the summer. But now we see the second half of 2022, there's actually been almost the double amount of rights issues compared to 2021. So a lot of companies have postponed their processes, but they have also, realized that we don't know how long the winter will last. We need to raise capital if we can find it. So I would say that yes, some processes are postponed, mostly IPOs, but the listed companies they cannot do that anymore.
And I can just add to that, I completely share the same picture, and that the market started getting worse already last year, for healthcare in particular. And I think what we have seen, if we look over the last 3 years, that not only have the number of transactions, and especially the IPOs, been much fewer in the Nordics, but also that there has been a shift towards more rights issues with strong support in a lot of them from current shareholders. That was raised in earlier presentations as well. And rather than directed share issues in the listed environment.
Yeah, and you share the same sentiment there from Penser?
Yeah, we do. We do mostly rights issues. We also are in the IPO segment, but we mostly do the rights issue transaction and directed issues. And we can see that there were many companies that were postponing it to after the summer. And we had actually a window here, the last one and a half months, where it was actually, we were able to secure a number of transactions. I think we released some 7 or maybe 8 transactions here the last couple of weeks. So what we can see, at least it's now that there is a shift to where investors and companies are starting to meet again. So at least some light.
Benjamin, do you think holding out and like we've seen examples of companies holding out and trying to wait out the market, is that a viable strategy? Obviously, it's tougher to raise capital when you have the knife on your throat, so to speak.
I never think it's a good strategy to try to gamble the market and make assumptions on where the market will be within 6 months or so. I think you should plan for the worst, of course. Always, you should at least have a plan for the worst scenario. And if there's money on the table, you should definitely seriously think about doing something if you need cash. And that advice is basically in any market condition, I would say.
And then seeing the transactions that have been made, capital raises mostly, then would you say that the expectations from company management and owners on the valuations has shifted a little bit since the last couple of years? What do you say, Benjamin?
If you're a listed company, it's quite everything goes faster because you have the price. You can look at the price and the valuation each and every day and second, if you like. So the expectation among shareholders and the company comes down quite rapidly. And there's a delay there when it comes to private companies. That's the common pattern. I don't think the discrepancy between when it comes to valuation expectation is a problem now. It was in the first stages of the downturn.
And I think if I could just add to that, I think it's quite interesting where we see buyers and companies or sellers meet. I mean, if we look historically in directed share issues in the public domain, the discount has been about 5 to 7%. It's really the historical level if you look like 10 years back or so. But looking 2022 year to date, it's more the 8 to 10% discount. So that is one thing to bear in mind, that the discount has come up in this much challenging market. And then I think also obviously that a lot of valuations have come down given the overall market as well. So, but I agree. I think more that, as you said as well, that buyers and companies and sellers are more on the same ground now, so to say.
So Jakob, at Sedermera, you do a lot of refinancing rounds for the companies. So negotiating around what kind of discounts that you have to imply, or what have the discussions been like? Have it been fierce?
Yeah, they're not always the easiest ones. Even if the expectations have come down from the start of the downturn, there are still very harsh discussions regarding the valuations, because the discount really comes into effect when you talk about securing a transaction for a rights issue, for example. You cannot find guarantors on the same terms as you did previously. So sometimes you need to offer 50, 60, 70, 80% discount on the current share price in order to find guarantors. And I mean, this is very tough to communicate with companies about this, because understandably, the shareholders, they can feel let down by a transaction communicated in this way, because it's not what they're used to. But then the market right now, it's not what anyone is used to. This is not the normal stance of how the market functions. So it is very difficult. But in the end, if you are going to raise capital, and you're going to raise capital that you actually need for the company to survive or to reach its milestones, then the negotiations will be tough, and the final terms will be tough.
And I also think in this environment, you can also really see how important it is to have a long-term and committed owner side, because we can see these huge discounts in companies where there is not a big base platform of the ownership that is securing the transaction. But in one transaction, for instance, where we have very strong support from the current owners, we actually had below 10% discount in a rights issue. So the ownership base is one of the most important part to work with as an early stage biotech company.
And if you look generally then on the investors, well, their appetite to actually participate in capital raises or share issues now compared with, say, 2021. What's your take on that, Benjamin?
It's on the same theme as the first question. I mean, it's definitely lower in general. And on the question about existing shareholders, I mean, one advice to companies would be also to not only in this type of environment, but anytime, all the time, think about your existing shareholder base and take care of them, because those are the ones that will support you if you continuously update them on what's happening in the company, and you have a plan for actually when when you end up in a situation like this, where it's extremely hard to find external capital or investors, you at least have a strong shareholder base that will support you. So that's something that's an important take home.
And I also think, if I can add, I also think in addition to the current shareholders, and I completely agree, I think it's also important to work long term with potential new investors, because a lot of them, especially specialist investors, take a lot of time and often want to see later data and the consistent messaging and meeting with companies for years over years. We've seen that in a lot of the companies that went public 5 years ago or so, and now actually US specialist investors come in with large tickets, but it has taken multiple years of delivering from the company and being there and being long term, and not only there for a specific transaction.
And obviously, with the market conditions being what they are, there's a decreased risk appetite. Are there any other general investor trends that you have observed in the last year or so, would you say, Don?
Well, generally we can see that the investors, they like to move to cash flow generating businesses, or in biotech maybe later stage or more de-risk cases. For instance, we can see that a lot of drug delivery companies are popular, where there is the substance is known and the cases feel de-risked.
Yeah, I agree. And just to add to that, more and more focus on balance sheets. And that's not only for this downturn, that's how it's been historically as well, but a lot of focus on cash flow as well as capital need.
You could also say a trend is that everything takes more time. If you, in 2021 or after the initial downturn of the pandemic in 2020, many opportunities we presented to investors could be signed, almost too quickly because the interest was so huge. Now it takes so much more time because the investors are so much more picky about everything, really.
And maybe if I may add, when it comes to trends, one positive thing with the valuations that have come down is that we definitely see interest from investors that usually don't look at publicly listed companies that are now having serious discussions regarding some of the companies that they find interesting. So it's a really interesting dialogue with private equity type of investors and other investors that only do private investment usually, that are now looking at listed companies. And also when it comes to, the healthcare sector is really, it's a huge heterogeneous sector. Some companies that are close to profitability or profitable companies, those have been during this time thematically extremely interesting. So, and on the other end of that spectrum, you have typical biotech companies with development risk, which is on the other side of the spectrum, which is not as thematically interesting when things are tough.
And so the market sentiment, of course, then it affects investors' appetite to take risks and to participate in capital raises, but it also affects the cost of raising capital a lot. What type of how do you handle this? Because as advisors, what do you advise? Do you advise companies to take in less cash but more often, or do you think they should go for bigger tickets, so to speak? If I start with you, Jacob.
It's a tough question because I wouldn't say there's one recipe that fits all. You can see all different kinds of setups where you because of the compensation to guarantors, for example, has gone up. Perhaps you secure a smaller part of the transaction, so the compensation part doesn't grow too much. This, of course, brings with insecurity to the transaction as a whole. So it's not an optimal solution, but it's one thing you can do. Also, offering shares to guarantors instead of cash can compensate the net capital that the company receives from the transaction. But regarding splitting up transactions to doing perhaps a unit issue of shares and warrants. It comes with pros and cons, so I wouldn't say that there is one solution, unfortunately.
I think that's what we said here earlier, that if it's money on the table, a company would be wise to take them if there is the opportunity. But otherwise, you should always have an alternative route and maybe plan for, if there is only possible to raise a smaller amount than initially planned, to have an alternative route with reaching some minor inflection points to maybe be able to raise more capital later.
But when in these cases, when, like you said, maybe you should try to reach the next inflection point and see if you can raise money after that. Then again, in an ice cold market, what we've seen experience-wise is that even if you reach the inflection points, maybe there's not that big of a reaction in the market that doesn't affect the share price that much. So what should they do then, the companies, when they face that situation and the cash is running low, so to speak? Do you have any ideas about that?
I mean, it's a very tricky question, and there's not one right answer, but I guess it's to prepare for all sorts of financing solutions. If you are a private company, some of the IPOs that were planned were not possible to complete, so we've done private financing routes. That's one alternative. Obviously, if you are in the public environment, then just stay prepared. We know that markets will improve and it can change quickly. So just explore all options that are on the table and be consistent in your messaging with investors and advisors and everyone, and also just be prepared on all sorts of options.
Mm. Is that your best advice as well, Don?
I think that it's a very limited options to pursue this route, but there could be some companies that are well funded, but has maybe for some reason maybe they have they will not be able to continue with their research platforms or something, and then there could be a merger opportunity, but there is limited number of opportunities for that solution.
Mm. And well, we are where we are right now, but if we look ahead a little bit, what's your view on the market outlook, and what kind of signs are you waiting on to see, see some kind of a brighter horizon than within the next 12 to 18 months, for example? What do you think, Benjamin? Are there any lights?
There are definitely lights, I would say. I mean, and also what we would look for is, I mean, IPOs is one important indicator. If we have a couple of successful IPOs on this side of year end or beginning of next, that's a good sign that the market is opening up and the risk appetite is there, we're quite optimistic actually, but everybody knows that it's not. I mean, it's really macro driven now. So, but if things stabilize and nothing strange happens, we're quite optimistic.
Yeah, I think that is really the lead world, that we get more stabilized markets. I think this is the worst kind of market to do transactions in, especially IPOs that take long time to price, and where you have those really strong reactions, both positive but even more so negative. And even as you said, you can have positive data, but the share price still falls because you expect financing or what have you. So it's really difficult to predict and price transactions in this environment. So that I agree.
And historically, at least in the life science sector, when the valuation has been gone down so much as it has been doing now for the last time, There has been an increased interest from big pharma that acquisites other smaller companies, and that is often that provides the sector with an early turnaround compared with the stock exchange in general. And we could, for instance, see AstraZeneca acquired a company this morning. So some of that activity could bolster some inspiration or renewed confidence by the investor community.
Confidence boost is certainly welcome in that respect. But as advisors then, who are sort of the intermediary between companies who are your clients, who seek to raise cash regularly, and then the investor networks that you work with, how do you present in current times this sector, the life science sector, to your investor networks in terms of making it attractive to them? What are the most important selling points that you would show? Is it that the fact that valuations are low now, or is it something else? What do you say, Anna?
Yeah, no, I think really it is, and I think it's that is really the case as well. That this is the least cyclical sector there is, and that is healthcare broadly. But you can really tell in this more challenging market that, and as said, that even a lot of generalists are also focusing on this sector. And I think that is really a key selling part here. It's not based on the overall market as so many other cyclical sectors are. So I think that is a clear benefit. And then also, obviously, it's very case specific and really data driven for a lot of biotech names as well.
So with a few minutes left, then I would like to get like a final round of your best advice then to companies. I'm sure there are a few companies represented in this room who are thinking right now, or sleeping maybe not so great at night, thinking about how to keep their companies funded in the next 12 to 24 months. What would be your one best advice to them? If we start with you, Jacob.
Just one?
Oh, well, you can give them three. I'm sure they appreciate it.
I'll be quick. Plan ahead. Like we said earlier, if you're raising capital in 2023, you need to already be talking to your financial advisor or within the board. Communicate with your investors, with your major shareholders. You need to have them on board, and you need to keep them informed on what's going to happen next year. And hold on tight to the cash you have. Don't spend it unwisely. And if you find capital, take it.
Good advice. What about you, Anna?
I agree absolutely that the key is to prepare ahead and be well prepared, but also be consistent in messaging with all types of investors, both current and potential new one, and be consistent and be long term.
And we of course agree. It's very important to go to us financial advisors early, because the whole process takes longer than you think in a normal market, and during these times it takes even longer. So it will take some time to actually secure finance. So go early.
And I can only agree with everything that you said, but maybe add that think about the positive thing with the more troublesome market, or with less deals being done, is also that the investors are not as crowded with offerings. So you can get airtime, but in order to get airtime, you maybe need to think about, together with your advisor, a shorter target list of investors that really makes sense. And try to tailor make your equity story towards each and every investor, why they should actually invest in your company.
Yeah, thank you very much for that advice. So I guess the main takeaway then would be to circle the networking session after this, when we have a break, talk to the right investors, be prepared, and if you haven't already thought about it, you should definitely come and see these people in the break to talk about your next financing round. Thank you very much for taking the time to be with us today.
Thank you.
Thank you very much.
Thank you.
Thank you.